Thanks for joining us. We've had a very exciting morning with the regulator also coming in. But I just wanted to start with, when we're talking about the infrastructure building and the role of insurance, right? Where do you see insurance coming in when it comes to building infrastructure? Ajit, I want you to take the discussion forward with.
So let me jump in. Thank you for inviting me, and it was a great session in the morning. And I think the speech of the chairman was very sharp, and lots of points came out. So on the connection between infrastructure and insurance, basically infrastructure build out requires long-term capital and patient capital. Typically infrastructure projects, whether they are road projects, airports, ports, I would say even in the social sector, they typically have a large upfront investment requirement, and the payback period is somewhat extended. And actually, the return on this investment makes sense from a longer term perspective. Of course, infrastructure has a public goods aspect to it. And typically, there are different risks involved. There is risk before the project is conceived. There is risk when the contracts are signed between, typically it's, infrastructure is largely financed or initiated by the government. So there are risks involved at that stage. And once the infrastructure asset is created, then the risk is of a very different kind. I mean, for example, if a highway is built or the toll road is built, then it's a question of operating the road, maintenance, and collecting the tolls. So at that point, there is something called takeout financing that other investors can come in. We have things like investment trusts and so on. But the insurance, typically life insurance, is a repository of large and patient capital, which requires, because if you're matching assets and liabilities, you need to match your liability with something which is a long-term asset. So infrastructure is ideal for that. So that's why it plays a very important role. I don't think just life insurance, but also pension funds and so on. And we have seen that in India, not only from the insurance industry domestically, but also internationally, like Canadian pensions and so on. Just one quick point, I want to emphasize that infrastructure is a big driver of growth in India, by the way. When we say India is a fast-growing economy, a very big and significant driver of the growth is infrastructure spending, and it is a structural determinant of growth. It does not depend on the business cycle. It does not even depend on, what is the flavor of the political establishment. And this is going to be around for at least a couple of decades because we have a large catch-up. In the last 5-6 years or maybe 7-8 years, infrastructure spending has gone from roughly 2% of GDP to now 4%, 4 or 6%. So there's been a very big increase, largely driven by the public sector. 70% of the contribution is by public sector. And the matching with insurance, the patient, it's a very good match. It's an opportunistic match that you have a growing insurance industry which provides long-term patient capital, which is the requirement of the infrastructure spending sector.
Right.
So, Mr. Sood.
Your perspective on where insurance as a long-term capital provider can come in. Yeah, sorry.
So I think what Professor is saying is perfectly on the dot, but it's an interesting perspective. So you have life insurance and general insurance. And life insurance, as he mentioned, has this long-term patient capital because such is the nature of the business and the policies. And they really need something to match that horizon for investment also, which infrastructure. So, well, life insurance might lend more to the investment and GI does, but the entire protection is provided by the general insurance for the lifetime of the cycle. So the entire industry, I think, plays a very critical role in project to execution to its piece of continuation till the end. And it's a very interesting point. What Professor mentioned was that it depends upon how the insurance industry is growing and the need for infrastructure investment. So we have a very nascent industry. Everybody keeps talking about low penetration, so the opportunities are more. And even if you look at the way the insurance companies have been investing, ever since slowly the infrastructure piece has been opening up with the InvITs being allowed to insurance companies to invest in and other securities, the investment in infrastructure has over the last, I would say, about 10 years, grown about not in terms of a CAGR, but 4x, 3x of their investments in the life insurance and the general insurance space. So I think it's a perfect fit. It's what will give the capital. The insurers also need something that is going to give them that kind of a horizon, that kind of an investment horizon, and a steady flow of returns also, so that they can be sure. Because ultimately, when you look at it from a life insurance perspective or from a pension perspective, it is policyholder funds. So you have to be secure. You have to be very confident about it.
Okay, I'm just going to stick with you because being with the regulator, what's your take on the impact of government policies and the IRDAI on infrastructure insurance market?
Sorry?
What is your take on the impact of government policies and the regulator on the insurance infrastructure market? Like, is the regulator doing enough, and do we have a free enough environment where insurance companies can invest in infrastructure projects?
So, see, that piece I think has always been in place. It's only growing. So it's not just a question. If you look at the investment guidelines and the investment regulations, it's not just about seeing what is directly in infrastructure. There has been from day one, both for the life and general insurance companies, a well-defined perspective of regulation for how much at least they should go into central government securities, state government securities also. So that kind of an investment also gets rooted into infrastructure. It's only that in the recent times, in the last 3-4 years, the options of directly investing. You see, insurance companies, how directly you can invest in an infrastructure project and at what stage depends also on the capability that you have to analyze and understand the complexity of the project, the risks involved in it, because you're putting in policyholders' money. But with the coming in of InvITs, which and banks also moving towards short-term loans, so that at least there is a big opportunity as and when there is a chance of transferring the execution, after the execution at the operational stage, to these entities, to these funds. So new options have been coming up, and the regulator has been continuously responding in order to open more and more direct investment that's coming in.
Okay. The other thing that we have is, there's a lot of complex risk when it comes to insurance requirements in public-private partnerships, right? How do you allocate that risk in public-private partnership models when it comes to infrastructure projects? Yeah, you can take this.
Yeah, I was going to say that there are these execution risks, and then there is the risk in the operational stage. I think the risk involved in the operational stage is considerably lower. And Mr. Sood also pointed out that the avenues for investing insurance funds is either directly by insurance companies into the projects, either at the investment execution stage or later, or more importantly through state government and central government bonds, because they subscribe to central government bonds or state government bonds, which in turn are investing in infrastructure assets. And incidentally, 70% of infrastructure today in India is being built with public sector funds, either center or states. And that's a very big driver of growth. Now, when you ask me about what are the risks involved with the public-private partnership, and here I'd like to mention to the regulator, see, the PPP model was pushed in a very strong way almost 15 years ago, 20 years ago. I think it was a flavor of the day. And then we had this period around that time where there were long delays. You know, we called it policy paralysis or something. There were long delays in some of the projects were just stalled. And it turned out that the stalling was because of the disputes that arose on getting approvals. Let's say a lot of the projects got delayed because of getting approvals, environment clearance maybe, or land acquisition. And then there was a tutu-meme kind of a thing going on between the public and the private entity. And the equity, because the private entity had brought in equity, and therefore who's to be blamed for these delays? I mean, if the project delay is getting delayed because of some approvals which are in the domain of the sovereign, in the domain of the government. And now that risk, how do you factor that? Is, I don't know what to call it. It's basically a macro risk. It's a sovereign kind of a thing that. So I don't know if insurance companies will be able to provide risk cover for that kind of a risk. I mean, I'm thinking of MIGA, which is a very global thing from the Western example. But that is, so therefore what happened, by the way, we actually moved away from PPP. So largely we have now gone on a model where it is the the building, the execution now is completely taken by the sovereign and then is farmed out to the private entity. So in that sense, I think we have understood that it is better, the risk mitigation is better if the execution is completely in the hands of the public sector. But I don't think we have completely solved it. And in the sense that this risk, which is beyond the execution risk, which is about approvals and external macro factors, we have to keep in mind. Also, I'd like to mention a smaller aspect of this, which is beyond execution. Once the toll road is now in place, so now investors come in and toll operators come in, and they sign these long-term contracts, let's say with the National Highway Authority or whoever it is, and the long-term contract has a viable, the return is viable because you have a toll rate fixed for every year for the next 20 years. And there's a formula. Now you can't have the formula getting changed in the middle just after 2-3 years because of whatever, political consideration. So that is another risk which perhaps has not been highlighted enough, but that's also there, that these operators, when they come in at the post-execution stage, the risks are different, lower, but we also have this new source, which is, long-term contracts should not get destabilized due to extraneous reasons.
The other thing, even the chairman also spoke about it, is with so much of climate change also coming in, I think there's an increasing focus on catastrophic risk that's coming in, CAT. Ensuring infrastructure against natural disasters, and how affordable is CAT coverage now? How much of that are you bringing in?
I think affordability of CAT coverage is not the issue at this stage. I think what is the issue is the awareness and the desire to go in ahead and take those CAT covers, both for infrastructure as well as for the general population. I think the CAT covers or the catastrophic events these days, it's not just the size and scale, but it's also the location at which they're happening. The CAT covers seem to find a new location at every point. So, you really cannot be identifying from your traditional and historical models of saying that these are the areas where I need to focus on. There needs to be a much wider and a much broader approach to this. So, and the CAT, at this stage, I think the CAT covers or the entire protection against catastrophic events is more or less being looked at as either insurance or either with the government or with the state authorities or with agencies related to that. I think it will have to be a mix of these, of multiple layers, pools, what can be transferred to insurance, what can't be transferred to insurance, and then layers on top of that. Because it's three things. It's the size and scale, it's the timing, and it's the location. All three variables are at play at the same time. The worst thing in risk management, especially from a physical or any risk for that matter, I would say, is that innocuous looking risks which independently are manageable, when they act together on consonance, can be catastrophic. And I think that is a perspective that we started looking at immediately. And the second thing I think is important for us is that CAT events, as I was mentioning in the morning also to someone, is that CAT events are fine. There are certain events that will happen and go because you're also putting in risk mitigation measures, especially when you're building on infrastructure and all. These days, when you're going in for infrastructure construction, building or any project, you think about these and the mitigation measures that you put in place ahead only. But every CAT event does not mean that it will be a disaster. That disaster comes in as to who all it impacts in people. And that is very critical. The CAT event or a weather event for somebody sitting on the 14th floor is not the same as somebody who has a small hutment down there. For one person, it's an event of rain and heavy rain that's passed away. For someone else, it's a disaster. So I think these are the things that are necessary for us to look at CAT covers when you look at catastrophic insurance and protection as a whole and mitigation.
Okay. I mean, we could take this discussion much longer, but we're running a little behind time, so I'm going to cut it short. Coming to you, Mr. Ranade, just, what reforms, just one last thought on it. What reforms do you think the regulator should consider, and what would you put forth to the regulator to strengthen insurance ecosystem and boost the consumer confidence in insurance?
I mean, if you are referring to the reforms that are the industry demand as well as the potential stuff which is coming on the insurance bill, I don't think from the infrastructure financing perspective, at least that's my opinion, is not something very critical. For example, the amount of leeway that's been given by the regulator to the insurance companies in terms of investment or exposure to infrastructure projects, that's fairly liberal. It's not very constraining. Secondly, there's an indirect route as well through the state government bonds. And thirdly, there's also the participation in investment trust, infrastructure investment trusts. I think that perhaps can be looked at. I mean, there are more structures there. But surely from that, if you open that up more, and maybe on retail participation, but then it goes into SEBI and other regulators. So, yeah.
It's not just about investment. I'll just give you a direct linkage, which you started with, Professor, is that whatever reforms that come in, whether it is the act, it is a regulation or anything, the fact that if we deepen penetration in insurance, bring in more funds over there, there will be more flow into the infrastructure segment also. So I think that is a direct contribution, and for that, I'm sure, as Chairman would have mentioned, there are three things that we need to look at all reforms, whether from the act or the regulation or at any stage. And that's how are we improving affordability, access and awareness. As long as we address these three things, expand the base, premiums increase, AUMs increase, more funding into the infrastructure.
Absolutely.
I think that works that way also.
Absolutely. I'd like to add to that because it came in the chairman's speech that actually the growth that we require is at least 3 to 4 percentage points higher than the nominal GDP growth rate of the country. I think that's a great point that he made. And I was talking to the LIC chairman, and he said if you look at LIC's 60-year history, the life fund growth rate, I was astonished to know, I didn't know, it's my ignorance, has grown at 16% CAGR for the long period. It's an amazing number, but I don't think that's the growth we are attaining in the recent past. So if we can aim for that, as you said, both penetration and density, automatically some of the infrastructure funding problems will get resolved.
Great. On this note, I'd like to end this discussion here because we're running a little behind time. Thank you, gentlemen, for joining me. But we'll take this discussion offline as well. Even during lunch, we can carry it on. Thank you.